Hey guys, Stockaholics, I appreciate you guys for being here today. Today I'm going to be talking about investing in US treasuries. Okay, I get it. Believe me, I know many of you guys might be interested in things like gold. You guys might be interested in Bitcoin. And you're thinking, what the heck is wrong with this guy? This guy's going to be investing in the dollar. I told you guys I was a contrarian, right? And I know bonds aren't sexy, right? So I'm going to try and lay out the case on why I am investing in bonds. This is an investment advice. And I would also like to suggest that this is one of the most complicated and confusing ideas also. And I'll be trying to explain the most confusing idea ever in 5 steps. First of all, bonds' relationship to interest rates, which are inverse. Number 2, deflation. And the Fed isn't actually going burr, but it might be in the future. A lot of smart people on both sides of this one. Okay, number 3, TLT. We're going to look at this. This is a bond ETF in 2008 and 2009. See if we can notice any patterns and if we can gain some insight into what might happen in the future. We are, in both of these time frames, are in a very serious insolvency sort of situation or recession. Yeah. Number 4, banks. And what they're doing, they are buying like crazy. Number 5, the largest net short position of all time from hedge funds and retail investors. Okay, I want to show you guys this. These are the interest rates versus bond prices, or TLT, over a period from 2000 and roughly 3 to about 2020. You'll notice that in this chart, as interest rates go down, you'll notice that there is an inverse relationship to bond prices. Now, I think at first glance, for many people, that this is going to be counterintuitive. You're thinking, well, why are bond prices going up if the interest rates on bonds are going down? Okay, let me try and explain that. So why do people pay more for treasuries if interest rates go down? Let me try and explain this with an example. So let's say you and I are in 2008 right now. And we'll say this is July or whatever. And we'll just assume that this is about 4.5% interest, right? So if I went to the US government in July of 2008, where my mouse is, and I said, hey, I want to buy a bond, a 30-year bond, or whatever it is, at 4.5% interest rate. And then I went to the government and said, okay, here's $1,000 for that bond. And I would like that 4.5% interest rate. The government says, fantastic, great. We made a deal, right? But then let's say a few months later, the interest rate dropped all the way to 2.5%. Now I could go and sell that bond to somebody else at a higher rate. And the reason for that is because this person, if he went to the government now and he says, hey, Uncle Sam, I would like to buy a bond for $1,000. Well, the government's going to say, well, you know what? Well, the interest rate now, it's 2.5%. You know, I know a month ago it was 4.5%, but you know, tough times are tough. Well, I'll give you 2.5%, right? So the interest rate, if this person bought this bond from the government, is going to be a lot lower than it would be for me. So he's thinking to himself, well, you know what? I could buy this bond from the government, or I could buy it from this guy. This guy might sell it to me for 4.5%. So he might come to me and he might say, you know what? Your bond has 4.5% interest rate. You know what? I will pay you, I don't know, we'll say $1,050 or $1,100 for that bond. And these are just, I'm not looking at the math. Obviously, he would do some math in a spreadsheet, see what makes sense, right? For him to accumulate some value over that time, instead of paying 2.5% yield, right? So if we look at these charts, you notice as these prices go down, these kinds of situations occur more and more where older bonds are more profitable to hold than newer bonds. So as these newer bonds become less profitable to buy from the US government, older bonds become more valuable. And so you can see, for example, these the price of these bonds goes up over time. Now, if it wasn't confusing yet, well, it's going to start to get a little confusing, I think. First of all, the Fed isn't creating money. It doesn't have the ability to do that. And I'll explain how you can tell in a little bit, right? There is institutions, however, that can create money, and those are individual banks. But before I get into that, the Fed does have superpowers. They have a super ability known as jawboning. Now, the Federal Reserve, it has a mandate. The goal of the Federal Reserve is to create as much economic stability as they can in an economy. They have a limited amount of tools, but this is, I would think, is probably one of the more significant ones, and that is public perception. They can say certain things, and they can influence the public to do things that they want. So for example, let's say that you are the Federal Reserve and that you know that you cannot create money directly. Well, let's say that you went out and you said that you can, and maybe I'll include a clip from Jay Powell where he's saying these kinds of things. What do you think that would have, what kind of influence do you think that would have on an individual? So let's say I'm stockaholics, and let's say, you know what, I'm kind of a little nervous. I don't, I'm not sure about spending money because we're in a recession. I love Applebee's, but I don't want to go to Applebee's and spend money that I might need on a steak. Well, let's say that I'm the Federal Reserve now, and let's say, you know what, there's going to be inflation coming because I'm going to print a bunch of money. What do you think that would do to an individual person with their money? Well, let's say that I would be a little hesitant to go to Applebee's under normal conditions, but let's say if I think that there's going to be inflation coming, I might go out. I might go spend money that I would otherwise be hesitant to spend money on. Additionally, if you think about March and April this year, where there was a massive liquidity event in the stock market, there was a huge amount of fear. Let's say that you think that there's going to be inflation coming because the Federal Reserve can print money. Well, you might go out and you might buy equities. You might buy stocks. And what would that do? That would put a psychological floor on the stock market. Okay, but the Treasury, it's not printing cash all day. If they were, the government debt would be zero. That government debt keeps going up and up and up and up. And in the US, money is actually created in the form of debt. And I'm going to show you guys that in a second. So, number two, when this government spends money, it has to get that money from two places. Number one, it can get it through taxes, but if we're in a spending deficit, it has to get it from somewhere else. The place that it gets that is through Treasury bonds, and it's effectively borrowing money from investors and from banks, as well as the Federal Reserve Bank. So often the Federal Reserve is going to be the buyer of last resort, if you will, and it'll buy a lot of these kinds of treasuries. Then it's going to sell, the Federal Reserve is going to sell those to banks, and you're going to, which is crucial to this investment thesis, banks sell those to investors. But before I get crazy into that, let me show you guys this on how money is created.
When banks make loans, it actually increases the money supply. How does that work? Well, the money supply is the total amount of money available in the economy at any time. Suppose a bank has $10,000 in deposits, and it lends out $9,000. That loan initially increases the money supply by $9,000. Now, if that $9,000 is deposited in another bank, and that bank keeps 10% in reserve, $8,100 could be loaned out. Repeating that cycle over and over again until there's nothing more to lend, it turns out that the original $9,000 loan can increase the money supply by a whopping $90,000. That's how money is created. The opposite is true too. When people repay the loans, it shrinks the money supply. Here, when the first $9,000 is paid off, it reduces the money supply by $9,000. However, the bank will be quick to relend that money and return the money supply to its original size. In effect, money is being constantly created and destroyed and created again through banks' loan-making practices.
All right, so something else to consider. You notice in that video that the bank is loaning only $9,000 of a certain $10,000 amount. So generally in the United States, when a bank reaches a certain size, and this varies a little bit, especially for smaller banks, but large banks, they generally have a 10% reserve requirement. So if there's a $10,000 loan, that means that they need to back that with $1,000. The Fed can give banks additional reserves to potentially allow them to lend out more money. And that's what we've seen recently, right? So the Federal Reserve, also known as the Fed, is the central bank. It monetizes US debt when it buys treasuries, bonds, and notes. And when the Fed purchases these treasuries, it doesn't have to print. It doesn't print money to do that. It issues credit to its member banks that hold those treasuries by adding those funds to the reserve deposits. So when those reserve deposits increase, that should theoretically allow the banks to issue more loans and in turn create more money for people because the banks can theoretically lend out more money. Okay, but here's the other side of that, and that kind of explains why there is deflation and recessions, right? First of all, in recessions, credit tightens. So people, in recessions, if you think about coronavirus and etc., if you look at the jobs reports and you look at initial unemployment claims, they've been massive over the past several months. Now they've been decreasing, but if you think about these initial job unemployment claims, they're still huge compared to a normal level, right? So if you think about that, on top of that, you think about businesses. How many businesses are going under because of these government restrictions or because of just general conditions that are not conducive to individual businesses, because maybe people aren't ecstatic to spend money in their whatever kind of business that is because of coronavirus. Yeah. Now, this causes something in the banking system. It causes credit to tighten. Now, in recessions, banks, they're less likely to loan money because these people who are seeking loans, they become bigger credit risks, right? The bank's not stupid. They want to make a profit on these kinds of loans. If they know that XYZ business is a restaurant and that their business sucks because nobody wants to go to XYZ restaurant during a coronavirus, cerveza sickness, they're not going to lend this business money. They know that this business is unlikely to be able to repay that money, and thus the bank isn't going to be able to likely make money on that loan. So even though the Federal Reserve is adding to the potential amount that banks can loan out by increasing the fractional reserve, increasing the reserve portion of the banks, yes, the banks can loan out more money, but they're not excited to do that because everybody in a recession is a bigger credit risk. So it doesn't particularly cause inflation. Rather, when we see how money is created, recessions cause the opposite. Credit tightens, and thus as a result, the dollar increases. And we think about this in terms of bonds. If you're thinking about a dollar increasing and you're getting a yield on that dollar, makes bonds a little bit attractive. Yeah. Also, so let's take a look at this. In 2009, for example, the inflation rate was negative 0.36%. This also caused the stock market to be crashing. So if you can think about these kinds of things, let's say that you believe that the stock market is going to crash in the next year, and also that simultaneously that the dollar is increasing, the attractiveness of bonds goes up a lot. Okay, so here I wanted to briefly show you guys what happened in 2009 with the TLT stock. If you watch any, like for example, if you went and looked at the S&P 500 in 2008, 2009, it would be an inverse of this. And I believe I mentioned this in previously. A lot of this stemmed from when people finally realized that there was deflation going on in the economy. They saw that the inflation rate went negative, meaning that the dollar was increasing in value. And they also saw that the stocks were becoming more and more insolvent. There was incredible risk, so it drove an incredible flight into bonds. And then you can see that the price of these things went parabolic. It went from approximately $90 to $120. So there was a significant increase, probably a third of the value, which is a huge move if you consider just what you're thinking about in terms of bonds, right? Now, if you think about that in terms of where we are today, in March and April of this year, we had something called a liquidity event. This was not an insolvency event like we have seen here. The bankruptcies and the general ability of people to pay their loans back to banks, things of that nature, they haven't happened yet. And the reason for that is because first of all, we have seen stimulus, and second of all, we've seen deferments on these kinds of loans. We've seen extensions on unemployment benefits, which have also led to for renters to be able to pay their rents for longer periods of time. So you can see first of all, the real shenanigans for the global financial crisis started before 2009. Started in 2008, but we really didn't start to see this parabolic move in bonds until that insolvency event was really taking place, until people really understood what was going on, and until people really noticed that there was a negative inflation rate happening, right? And if you think about that for a second, that's important too. Like if you think you're buying a bond, right? And if you're imagining that, and I've talked about this before, people are really good at figuring out what's happening in the present, and they're not so good about figuring out what happens in the future, right? Let's say that you're going to buy a bond and you think that the future is going to have a negative interest rate. What that means is that you're getting an interest rate on an asset that is also increasing in value. Your dollars that you're paying now are going up, right? Now, is that likely to happen in the long run? No. But if there is a massive sell-off in the market, which happens because of these insolvency events, and people also see that there is what they perceive to be security in those bonds, it causes these kinds of parabolic moves. And if we're thinking about what's happening now and what could happen in the future, I think that it's very likely that we could see a similar event in perhaps 2021 that we saw in 2009. All right, so I wanted to kind of show you guys this article to kind of think about step number 4 in this, and that is what banks are doing in terms of bonds. So banks are piling into treasuries, helping to fund the government borrowing spree. The demand from banks and money markets funds help absorb a flood of new debt. Now, banks, they're not a, let's say, they're not a soup kitchen. They're not a charity. They're not doing this for the government's benefit. They're doing this because they believe that they're going to profit by doing so, right? So yes, although the government has issued $3 trillion in debt, and a lot of that has come through bonds, a lot of this money, these bonds have been bought by banks. And I would argue that the reason that they're doing this is because they believe that they're going to be selling these bonds at a higher price during an insolvency event. So surging deposits and declining lending are driving banks to dramatically increase their holdings of U.S. Treasuries, offering significant support to the bond market at a time of massive government borrowing. So if we look to that chart that I mentioned in the last one, the banks knew what happened in 2008, 2009. In 2009, we saw deflation. We saw a stock market crash. We saw significant insolvency. And the banks are anticipating a similar event happening now. And although this is a little bit older of an article in September 20th, I've looked at a lot of the data, and the banks, they're still buying like crazy. They're still buying bonds. They're doing an anticipation of the insolvency event that has the bankruptcy, the mass bankruptcy event that hasn't happened yet. This suggests that the bank believes it's going to happen, and that they believe that it's going to lead to a stronger dollar, and the dollar is going to lead to an increased demand in bonds, and because there's an increased demand in bonds, with the banks already having bought it, they'll be able to sell those bonds for a higher price. Now, I'd also like to show you guys this. I mentioned this in a prior video, in the stock market crash video, but in any case, I'd like to this is the U.S. bond market, and the amount of people in the net speculative short position. So that a lot of this is including, would not likely be banks, because as we've seen, they've been buying bonds, but this is including a lot of retail, your general investors, and it's including hedge funds. If we look where we are, this is kind of the zero bound here, where this would be kind of a neutral long and short position. Today we are at a net standard deviation of 4. And this is the most amount of people that have ever been short the bond market. And I'd like to also remind you guys of what happened in 2009. This might suggest that we might also be into a similar event that happened in 2009, right? If you have this many people short the bond market, these kinds of trends, they tend to go in the other way. Like if you have this many people short a position, the market tends to go the other way. For example, and the other way, if we have an insane amount of people that are bullish, ultimately the market tends to go the other way too. Now, I'd also like you guys to notice that with this amount of shorts, with this the most amount of shorts ever in TLT, I want to go back and show you guys the TLT stock. With this amount of shorts, we've only gone this amount of change in the stock. And again, I believe this is because the banks are backstopping this. They're buying so many bonds that it is preventing the bond market from dropping. Although there is this many people that are short bonds, the banks have the opposite position. Now, if you're thinking about this insolvency event, if and when it does come, and you're thinking about this stock in TLT, what do you guys think it's going to do for the prices of bonds when you have this many people that are going to have to cover their short positions? And when I think about this in 2009, and I think about this again, it just seems like the ultimate short squeeze could be coming. I guess before I close, though, I will show you guys Mr. Powell and his superpower, which I mentioned before in job owning. But hey, I appreciate you guys for watching, and I'll see you guys next time.
Simply flooded the system with money.
Yes, we did. That's another way to think about it. We did.
Where does it come from? Do you just print it?
We print it digitally. So we as a central bank, we have the ability to create money digitally, and we do that by buying treasury bills or bonds or other government guaranteed securities, and that actually increases the money supply. We also print actual currency, and we distribute that through the Federal Reserve Bank.